Hello and welcome. This lecture video covers the cash budget and the budgeted or pro forma income statement. Okay, so the cash budget is one of the last budgets that we'll do that's in the master budget. And so we have a few assumptions that we need to talk about before we can do our cash budget. So we have a line of credit. So what a line of credit is just where you can go to the bank and borrow money. You know, I have a home, and a couple of years ago, I took out a line of credit to borrow against the value of my home, and I could use this to do any type of home improvements or pay for any other things that might come up for which I didn't have a significant amount of cash. And so it's the same thing over here. It's just a line of credit. This Royal Company can go to the bank and borrow up to $75,000. If they borrow, we have a few assumptions. All borrowing occurs at the beginning of the month, and then they have to repay it back at the end of the quarter. These are just the assumptions of this problem. Any interest that's incurred during the quarter is going to be paid at the end of the quarter, even if they borrow at the beginning of the quarter. So even if they borrow at the beginning of the quarter, they'll pay back the interest at the end of the quarter. The interest rate is 16% per year. Interest rates on line of credits are typically a little bit higher. Royal Company wants to have a cash balance of at least $30,000 at the end of each month. The cash balance at the beginning of April was $40,000. We have cash dividends that we pay. We want to pay at $51,000. Those can be paid to shareholders in April. And then this was some of the capital acquisitions budget that we discussed in the prior lecture video. We will have one equipment purchase of $143,700 in May, and then one for $48,800 in June. They will be installed and tested during the second quarter, but won't become operational until July, which is the third quarter, and that's when depreciation charges will start. Okay, so if we look over here with our cash budget, we can go ahead and start completing this. So we were told on the prior page that we had $40,000 in beginning cash. That was given to us, and that's right there. Okay? Then, cash collections. Look back at the schedule of cash receipts collections. Schedule of cash receipts and schedule of cash collections and for April. And when you look at that, you would see that we were anticipating collecting $170,000 worth of cash in April. We can add those two together, gives us our total cash available of $210,000. So it's kind of like saying you had $4 in your wallet to start the night, and then you withdrew another $17 from the ATM. You have $21 total cash available. Okay, same idea. Then we have to look at our cash disbursements. Okay, so we can look at, if you look in the prior budget that we did, the schedule of cash disbursements for direct materials, you would see that we are anticipating spending $40,000 direct materials for April. And this is from our schedule of cash disbursements for direct materials. That's where I got this from. Cash disbursements for direct labor, I'm going to go back and look at your direct labor budget. Go back and look at your direct labor budget, and you would see we were anticipating spending $13,000 in direct labor for April. Manufacturing overhead comes from the manufacturing overhead budget. Look at the manufacturing overhead budget, the cash disbursements for manufacturing overhead, and you would see we were anticipating spending $56,000 manufacturing overhead for April. For selling and admin, look at the selling and admin budget and specifically look at the line item for cash disbursements for selling and admin from the selling and admin budget that we did in this chapter, and you would see we're spending $70,000 cash disbursements in April for selling and admin expenses. The equipment purchases right over here, that's in May and June. We don't see anything for July, but we do see cash dividends in April. Okay, so there's no equipment purchases in April, but there were $51,000 of dividends in April. So now what we can do is we can add up our total disbursements. That gives us total cash disbursements, or cash that we have to pay, $230,000, but we only have $210,000. So what do we need to do? We need to go to our line of credit and borrow money from the bank during April. We have to borrow some money during April from the bank. Okay? How much do we need to borrow? Well, we have to borrow at least $20,000 because if we borrow $20,000, that means we have cash available of the 210 plus the 20, which means 230, and then we can meet our obligations right over here. But if you look at this prior page, it says we want to have cash at the end of each month equal to $30,000. So that means this number down here, our ending balance, we want it to be $30,000. So if we have to borrow $20,000 just to get up to here, and we want to have $30,000 at the end, that means we have to borrow total $50,000. Because if we add 50 to the 210, that gives us 260 cash available, and then the 260 minus the 230 gives us $30,000 in cash ending. So I'll come down here. Let's say my excess cash is $20,000. 210 minus 230, negative 20. I'm going to borrow that $50,000 that I was just talking about. And the 50 plus a negative 20, $30,000 right there. We don't repay anything until June, which is the end of the quarter. We don't do any repayments until June. We don't do any interest until June. Okay? Now, this is ending from April. And just like what we've been talking about with the other budgets, that becomes beginning for May. So what I want you to do is I want you to pause the lecture video now and complete down through here for June, and then we will review it together, and then we'll complete the rest of June and then the quarter together. Okay, so let's see how you did. So we have that $30,000 ending for April becomes beginning for May. Then we look to the schedule of cash receipts, or the schedule of cash collections, which was the budget that we did right after the sales budget, towards the beginning of the chapter notes. Add those two together. Cash available is $430. We spent $72,300 on direct materials, which is from our schedule of cash disbursements for direct materials. $23,000 for direct labor, which comes from our direct labor budget. $76,000 for overhead, which comes from our manufacturing overhead cash disbursements. $85,000 for selling and admin, which comes from our our cash disbursements for selling and admin. $143,700 equipment purchase, which we saw given on the prior page. There are no dividends. We only pay dividends in April, none for May. Add up all these, total cash disbursements of $400,000. The $430 minus the $400 gives us the $30. We want to have a balance of $30,000 at least, so we don't have to borrow anymore, and all repayments occur at the end of June per the assumptions of the problem. This $30,000 ending for May becomes beginning for June. Schedule of cash receipts or cash collections. Add these two together, $365. The schedule of cash disbursements for direct materials for June. The direct labor budget. Manufacturing overhead budget, cash disbursements for June. Selling and admin budget, cash disbursements for June. $48,800 of equipment purchases given to us on the prior page. 0 dividends. Add up all these, total disbursements $270. And then what we have is the $365 minus the $270 gives us $95,000 right there. We don't have to borrow anything because we have at least a $30,000. But per the assumptions of the problem, we do have to pay back this $50,000 right over here. Remember, we borrowed that. We have to pay that back in June because June is the end of the quarter. And then we also have to pay interest. Now, how much interest do we have to pay? What's going to be our principal, which is, we took out $50,000, which is our principal, times our interest rate, which is 16%, The problem is that's 16% per year. So we have to adjust the amount that we have to pay, because if we just said 50,000 times 0.16, that would be for the entire year. But we only have 3 months worth of interest. So what we do then is multiply that times the fraction of the year for which we had the loan, 3/12, 3 months out of the 12, which gives us $2,000 in interest. $95,000 plus a negative 52, or you could just say subtract 52, you get the same answer. $43,000 cash at the end of June, which is going to be our cash balance at the end of the quarter. Now we can look over here and look at our quarter 2, Q2 total. We have beginning 40,000 right over there. Then I can add across. That gives me my total cash collections, 905. Then I can add those two, the 905 and the 945. Gives me $945,000 worth of cash available. And then I can add my direct materials across, 185. My direct labor across, 50,500. Overhead, 191. Selling and admin, 230. And then my total from my equipment purchases, my dividends. I can add up all these. I get total cash disbursements of 900,000. 945 minus the 900 gives me 45,000 right there. And then I can complete my financing section. I borrowed 50,000 right over here, and then I repaid 50,000. And then I also paid $2,000 in interest. So total net financing here, these two cancel out, which means I just have that leftover 2,000. 45,000 plus a negative 2,000, or 45,000 minus the interest that you had to pay, gives me 43,000. These two numbers should be the same because the end of June is the end of quarter 2. Okay, so that completes the cash budget. Now let's take a look at our budgeted income statement. The budgeted income statement, another term for that, is the pro forma income statement. The pro forma income statement. That's another term. And you might hear that when you start working in your first job or in your first internship. Okay, so we have our income statement right over here. Sales, cost of goods sold gives us gross margin. Gross margin, also known as gross profit, subtracting out our selling and admin expenses gives us our net operating income. Subtracting out our interest gives us our net income. So we can pull our sales from the sales budget. And then we can also calculate our cost of goods sold. Remember, we thought we were going to sell 100,000 units. That's from the sales budget. And our unit cost, which we calculated, was $5. That gives us cost of goods sold of $500,000 right over there. That means our gross margin is 500,000. And then we can look towards our selling and admin budget, which is right over here. If you look back at the selling and admin budget, remember we had $260,000 total selling and admin expenses for the quarter, and that's from our selling and admin expenses. And that does include depreciation. Okay. Now, if we look back at our schedule of cash collections, we would remember that 5% of our sales we don't think we're going to collect. That 5% is bad debts. So we have to add in our bad debts expense here, which we did not include in our selling and admin budget, but we're going to include it right up here. So what we did is we took our $260 plus $50,000 bad debts expense, which is 5% of our total sales, and that was given to us. That's from our schedule of cash collections. So we can add those two, the 260, 310, 310. And then I'm going to let you complete the rest. Look towards the interest expense on the prior page, and then we'll check it. So we have our gross margin, minus the 310 gives us the 190, minus the 2000 gives us the 188.